Hello, my name is Victor, and in today's video, I want to discuss why I started a Netflix position in my portfolio. But if you have not seen part 1 of this analysis, I would highly recommend viewing that video first and then coming back to this more in-depth fundamental analysis video. But without further ado, let's get right into it. Oh, but before that, for anybody who celebrates Christmas, I want to wish everybody a Merry Christmas with this week. And to anybody who doesn't, Happy Holidays, and I hope that everybody has a great end of 2025. But here we are at the end of 2025, and Netflix is still struggling. Down about 25% over the second half of the year. Started off great, then we had that news about the Warner Brothers potential acquisition, and here we are with Netflix giving a screaming opportunity to investors like myself and potentially you as well. And we're going to get started here with the earnings report, and I did a deep dive into all of the reports so that you do not have to. If you appreciate me doing all of this research into stocks, I would absolutely appreciate a like as it helps out the channel tremendously. But in their most recent quarter, Netflix's revenue was up 17%. Love to see a strong double-digit growth number here on the top line. As for their earnings, it was about 8% up compared to this time last year. Now, normally I like to see that the net income is growing faster than the revenue, but we're going to have a deeper dive into more of the numbers here, and I'll explain why this doesn't really affect my decision here at all. Let's keep it moving now and go on to the balance sheet analysis. And here, I definitely highlighted in green that cash and cash equivalents were up 19% compared to this time last year. Something that I love to see, especially in a turbulent market like right now, where everybody's really honing in on fundamentals and making sure that if we were to dive into a recession here in the next year or two, companies are ready, they have cash on hand just in case the ride gets a little bit bumpy here. Now, I did have in blue the assets because they're pretty much stagnant year over year, but the liabilities have also stayed relatively the same. And as we have discussed on this channel, if your assets and your liabilities do not change, that means that the shareholders' equity will also remain the same. As always, I love to have a total liabilities divided by shareholders' equity ratio. And for Netflix, I found that that is about a 1.1, which is relatively in line to what I want to see. For those of you who are new to looking at balance sheets and looking at all of these financial documents, I just want to highlight that assets are generally on the top, liabilities are directly below that, and then at the very bottom of the document, you will find shareholders' equity. Equity, again, is assets minus liabilities. In general, you want to see more assets on the balance sheet than debts owed. And that is why I personally love to see this ratio, because I want to see something that is 1 or less than 1, ideally. For Netflix, 1.1 comes in line to what I would expect with a company of Netflix's size. And so far so good. We are now through 2 out of the 3 documents that I always have a look at whenever I am thinking about starting a new position in my portfolio. So I have a green check mark here as well for the balance sheet. Nothing has really caught my eye that has been overly concerning, and everything is going up and to the right, which is what you want to see. The final financial document that I always have a look at is the cash flow statement, because that really gives you an in-depth understanding of how the cash is being handled in a company. And right out of the gate here, I see that cash flow from operations is up 22% year over year for Netflix stock, something that is incredible to see. I also had a look here and saw this massive number here, which explains why they have so much cash on their balance sheet this time around. And that is because they had about $176 million that came in from sales from investments. If memory serves correctly, I think Amazon also had a massive jump in their cash on their balance sheet recently because of the same reason. I am not going to be upset with a company who is doing a great job of investing their money. And last but not least here on the cash flow statements, I circled in green here $1.85 billion that Netflix has done with stock repurchases over the last year. Absolutely amazing, because Netflix is not a company that pays dividends. So the best way that they would be able to give money back to the shareholders in a way is to lessen the numbers of outstanding shares, so that way current shareholders will have a higher amount of equity with less shares outstanding. If you have not subscribed, I invite you to do so that you can start hearing all of these financial terms more and more, because the more you hear them and the more you see examples of what I'm talking about, the better you will understand every single concept. If you have not seen part 1 of this analysis video, again, I highly recommend viewing that, because all of this will make much more sense, especially this section here where we discuss PE ratios. But for those of you who are just here to see what I think Netflix will do over the next coming years, Netflix to me is a screaming buy here at the end of 2025. So that is why my bear case is running through 2028. And in that situation, I have Netflix at $130, which would be a 12% compound annual growth rate from here. As a reminder, Netflix at the end of 2025 here, as of the time of this recording, is about $94. So that is me being absolutely conservative, and that would still beat the S&P 500. In my bear case, I've got to get into a stock that has any kind of potential like that. But even more exciting than that would be my bull case, again through 2028. And in this scenario, I have Netflix at $218, which would be a 32% compound annual growth rate in the next 3 years. Incredibly exciting, especially when you stop and consider that the S&P 500 on average grows between 7 to 10%. You know, if you start accounting for inflation, if you start accounting for potential fees that you might be paying, you know, it can get kind of wonky, but just know 7 to 10% is the average in my opinion. So 32% compound annual growth rate would be absolutely amazing. Now, again, this is according to my research. Never get into a stock or copy some guy on the internet just because he says or he gives his opinion that a stock is going to do well. Always do your own research. Always come up with your own numbers. I always tell that to all of my viewers, so please do your own research. But now I want to discuss a different type of ratio that we really don't discuss here on the channel, and that is the PEG ratio. That is the price to earnings. Normally, I like to look at the forward PE ratio, and that is divided by the growth rate that is expected for that stock over the next 12 months. In Netflix's scenario here, I have their PEG ratio at about 1.07, and I have a big old green check mark right beside that, again, because anything near or under a 1 is what you want to see whenever you're researching stocks. Specifically, that PEG ratio is great to use whenever you have a high growth company. Netflix is a stock that I personally have never owned, and that is through about 8 years of me being in the stock market. But I have absolutely heard of Netflix and have been keeping an eye on Netflix throughout those years. But I just never was able to pull the trigger and get a position started. Because if I was just looking at Netflix through a PE ratio, they're always so high because they have that absolutely amazing growth behind them. So in a situation like Netflix, it's great to see their PEG ratio because it accounts for that growth moving forward. But now that I have shown you and presented my research, I'm sure that you will understand why I started a Netflix position in my portfolio. My average cost for the position is right around $95 currently. And I would love to grow this position in my portfolio to be about at least 5% up to 10% of my total portfolio. 5 to 10% is still pretty bullish in my opinion. That's a decent sized position in my portfolio. But after viewing all of the numbers, doing all of the research, in my opinion, Netflix is a screaming buy here at the end of 2025. This potential purchase of Warner Brothers has given me the perfect opportunity I was looking for to get a position started in Netflix. To me, Netflix is like the Real Madrid of streamers. I really like to provide sports analogies because I love football, as I'm sure you can tell. Just like Real Madrid being the dominant force, everybody knows that when they're about to play Real Madrid, you better be on your game or you are going to get left in the dust. To me, Netflix is that level of prestige in the streaming category. I think they are the number one streamer. Based off of their numbers, everything looks amazing. They are poised and positioned to continue this excellent run of form into the future. Now, past performance does not guarantee future performance, and that tends to be the number one criticism of fundamental analysis. But in my experience, if a company can show that they are growing quarter over quarter, year after year, that tends to mean that they are doing something right and can continue doing it into the future. But I would love to get your opinions on Netflix stock and what you think of me starting a position here at the end of 2025 in the comments below. To everybody who has made it until this point in the video, thank you so much. Again, to everybody who celebrates, Merry Christmas and Happy Holidays to everybody else. And as always, I'll catch you in the next one. Peace.